Good morning again. This is Vivek Banerjee welcoming you to the session of security analysis. Today I will discuss the technical analysis part of the security analysis. Actually, I have discussed this portion sequentially. First of all, I have taken the fundamental analysis in which there was the economic, industry and company analysis. Then I went on to discuss the valuation of equity shares, and after valuation of equity shares, I am taking this technical analysis portion. Before going into the meaning of the technical analysis and grasping the concept of what technical analysis really is, let us understand what is the basic difference between this fundamental analysis and the technical analysis. I'm taking a hypothetical situation in which I think the difference might be clear to you. Let us say you go for a vacation in a particular city, in which you are not familiar with. You go for a sightseeing, and in the afternoon you got hungry. You go to the central market and you want to eat something. There are various restaurants, about 10-15 of them, and you are slightly confused as to which restaurant to go. An idea came to your mind. You asked some people on the basis of the feedback you got from the local people. You select 4 or 5 restaurants. You went there. You took a sample meal, some portion. You ate some portion, and on the basis of that, you took a decision that yes, it is a particular company, a particular restaurant in which you want to eat. So you go to the restaurant, you enjoyed the meal, and goes out. Then another person who is also vacationing in the same city and who also got hungry after the sightseeing in the afternoon, and he want to take lunch. He does nothing. What he does is simply sat in a bench and just observe for about half an hour or so. After observation for about half an hour, 45 minutes, he noticed that in a particular restaurant, the people were always coming. People were coming, people were going, and from the outside, he can easily see that the people were actually standing and all the seats were full. So he decided that in spite of it is not the peak time, it is in spite of that is the afternoon and not the evening and not a weekend, and restaurant is always full. He went into that restaurant, enjoyed the meal, and goes out. So the approach of these two persons are entirely different. So the first one, the former, is the fundamental analyst, you can say, and the latter one is the technical analyst. So what the fundamental analyst does is, on the basis of general observation, he took a thorough research of the environment, as we have discussed, in the environment, the industry, and the company. And the technical analyst basically goes by the crowd behavior, the crowd psychology, the human psychology. So human psychology plays a big part in the technical analysis. Now, just get on to the meaning of the technical analysis. Technical analysis is a method of share price movements based on a study of price graph or charts on the assumption that the share prices or share price trends are repetitive. Now let us understand this portion first. Technical analysts basically research on the share price movement based on graphs and charts. We will discuss the graphs and charts. And if the graphs and charts shows a particular trend, then a decision is taken by an investor whether to purchase in the stock of a particular share or whether to sell it if he is already holding it. And such decisions are taken on the basis of the share price trends. That is, in the past, that if the share prices are increasing, then he thinks that yes, it may continue to increase in future also. So investor psychology plays a big pattern, and one of the biggest as a main assumption of technical analysis is that the prices tend to repeat itself. That is, history repeats itself. That is, whatever trend which has been observed in the past will happen in the future also. The reason is that whenever the prices increases, the investor thinks, the retail investor or the general public thinks that yes, the prices will further go up. So they start purchasing again, pushing the share prices to a new level. On the other hand, when the share prices are decreasing, then the investors think that yes, for the fear of that the share prices will fall further, they starts selling. So, and this greediness, in the former case, it was the greediness of the investor that yes, the share prices will move further. So he purchases it. And then second option, the fear that the share price will fall. So he starts selling. So the greediness and the fear of the investor, the general psychology, is repeated again and again because of this human psychology generally works in most of the situation. So that is basically the fundamental concept of the technical analysis. Now we see some of the assumptions of the technical analysis. The first assumption is the market value of stock depends on the supply and demand for a particular security. Now, this demand and supply applies to every situation. For example, if you think that the price of a share will increase, you start purchasing it. And if you think the price of a share will fall, if you are holding the shares, you will sell it. So, if the prices are increasing, then it means the demand for that particular stock is more. And that will actually push the uptrend or increase the price of such a stock. On the other hand, supply is more means the people are selling. So prices are decreasing. There is a downtrend. So market value depends on such situations. If the demand is high, the prices are increasing. Obviously, the market value of stock will be more. On the other hand, if the demand is low and supply is high, means people are selling the shares, then the market value of such a stock will be less. So this is the first assumption of technical analysis. And the second one is the supply and demand are actually governed by several factors which can be rational or irrational. Let us take this. We have taken what supply and demand, how supply and demand affects the market value. Okay. Now these supply and demands are affected by rational as well as irrational behavior. So what are those rational and irrational behavior? Basically, the rational investor is a person who, before investing in a particular stock, goes through a thorough research. He analyzes, he sees the price trends, analyzes it, compare it with the previous trends, and then take a decision whether to purchase the stock of a particular company or not. What the irrational investor does is, he simply purchases the stock on the basis of his whims and fancy. He thinks that the particular stock will move up on the basis of tips given by one of his friend, or if he heard anything in the newspaper, the news channel, that there is a chance that the price of a particular stock will move up, he will purchase. So this demand and supply is influenced by both rational as well as irrational behaviors of the people. Now come to the third assumption. Third assumption is that the stock prices generally move in trends which continue for a substantial period of time. We will see that during our course of this lecture on fundamental analysis, that generally the stock prices move in trends. Most of the situation, if the share prices are increasing, then it increases for some time. If the share prices are decreasing, then it decreases for some time. Now come to the fourth assumption. Fourth assumption says that technical analysis relies upon chart analysis, which shows the past trends in the stock prices. As we have seen that the technical analysis relies upon the chart profusely. They read the charts, they analyze the price trend, that is, what is the price trend now, what is the price trend 1 month back, what is the price trend 6 months back, and then take a particular decision. So past trends are very important for a technical analysis. On the basis of the past trends, the technical analyst took a decision, because the basic funda of the technical analysis is that the prices tends to repeat, or the history repeats itself. Now come to the principles of the technical analysis. The technical analysis is based on the following three principles. These three principles are very important, and these actually forms the foundation of the technical analysis. So I will take some practical examples also so that you can understand it before going deep into this technical analysis portion. The first is the market discounts everything. So what do you mean by that? The market discounts everything. As you know, the market, that is the current market price, whether the Nifty or the price of any particular stock, it actually, the prices considers or it reflect upon the whatever past events have happened, what is the present events, on also the future event which will happen. So the market also considers the future event also. That is why it is saying that the market discounts everything. It is understandable that it is considers the past information, it considers the present information, that is, if the company has declared some dividend, if the company issues bonus shares, or it has given a public declaration that it is going out to the merger with some other company. So these information actually pushes up the prices of the shares. So these are generally publicly available information. But what about the privately available information, the insider information? That also the market considers. How? We will take an example to understand this. I'm screen sharing it with so this is the Nifty chart. I hope it is visible to you. And let us go sometime back about February 3rd, 2020. I have taken 3rd of February 2020 because on this day the budget of 2020 was actually declared. The budget of 2020, that is the previous year, was not actually very good from the point of view of the general public, because the general public were expecting some tax exemption and which were not given. So on this day, that is on 3rd of February 2020, here in the below, you must have been observing that the date is given 3/2/2020 in black. So on this day, the budget was declared and the market actually fell. This is the red candle. It is showing that the prices are actually decreased, or the prices fell on that particular day. So prices fell on that day. But what about here? Here you can see the date is given below you, 21st of January 2020. From here onwards, the prices start selling from 21 to 31st of January 2020. For the last 10 days, even before the you can say announcement of the budget, the prices were falling. What is the reason? Why this is so? The reason is that someone in the you can say system, or some insiders were actually of the view that the budget may not be good this year. So actually they start selling beforehand. They start selling from 10 days before, from 21st of January. The budget was declared on actually 3rd of February, and some of the insiders actually start selling from 21st of January itself. But these actually in trading, selling has been done by the insiders, but these are actually reflected in the charts. So an investor, thorough technical analyst who is doing the research, will be able to find out that here the prices are actually continuously going down. It means something is going to happen. The prices may fall further. So in this way, it can be said that, according to the technical analyst, that the market discounts everything. The current market price actually considers the future events also. So I hope this is clear to you. I'm again going to the PPTs. Now come to the second point, that is the prices moves in trends. As I've said that the prices actually moves in trends, uptrend or a downtrend. Let us take examples so that this aspect will also be clear to you, that the prices generally moves in trends, means either an uptrend or a downtrend. See, here the market is actually showing an uptrend. It's increasing. And this actually shown for it goes for some time. It actually continues for some time. From here onwards only, it's actually showing a downtrend in the month of this November. So the market moves in trends. Now the last principle, the history tends to repeat itself. And last but not the least, it is actually a very, very important, you can say, the principle of technical analysis, that the history tends to repeat itself. Means whatever past trends have happened tends to repeat. Why this is so? Because of the basic human psychology, the basic human behavior, which tends the person or the human being to repeat such actions again and again. So let us take this again an example of this, how history tends to repeat itself, or how the past trends actually sometimes repeat in the future also. We're taking some other company, let us try to find out this new trend. Taking this Axis Bank. See, here the trend, it is going up like this and going down and is going up. And this trend actually repeated here also, this portion. Let me highlight it. That is this portion. This portion, and again this trend repeat itself. It is not exactly, because actually in practical situation the trends will not be exactly, but more or less it was same. This trend which is witnessed in actually in the month of May and June 2021 has also been repeated in the month of August and this September also, mid 1st August to this mid of entire September month. So you can say yes, the market, the history actually repeats itself. The past trends actually repeated in the future also. Okay, now again get back to the PPTs. Okay, now come to this DOW theory of technical analysis. DOW is actually you can say, father of technical analysis, and his theories are more than 100 years old, but it is still relevant today. And one of his contribution is that he has clarified that the market can be divided into three parts, or it can be classified into three parts. That is the primary movement, the secondary movement, and the daily fluctuations. And this primary movement is the main trend of the market, which actually lasts from the 1 year to 36 months, or it may be longer also, 1 year to 3 years, or maybe longer. So this trend may be either bear market or bull market. Means it may either show an uptrend for a certain number of period, or it may show a downtrend for a certain portion, certain period. And this secondary movement is shorter in duration to the primary movement. And it lasts generally from a few weeks to a month, or maybe 2-3 months. And the last trend, that is this is also called the minor trend or tertiary trend, which is and also called daily fluctuations. So these are the last movement is the daily fluctuations from the day-to-day basis. Now, DOW theory is a basic foundation of the technical analysis. So, take some time. I will take some time to let you understand this, that how DOW theory actually affects the technical analyst, and on that basis, how the technical analysts take decisions on this, the DOW theory, the theory which was propounded by the DOW. So, I'm stop sharing here and going to the whiteboard. DOW theory. First, he said that the market can be divided into, or you can say market movements can be divided into three parts: primary movement, secondary movement, and the tertiary movement, the third movement, that is daily fluctuations or minor trend. So let us say the market is moving like this, and then it again comes to this. So it is actually, market is moving like this. So you can say this is the primary movement. And this primary movement, this is a downtrend, because you can see that the prices are actually, from this the prices are actually decreasing. This primary trend may be an uptrend also. So the primary trend can be an uptrend also. The prices are moving in this situation. This is the primary trend. So primary trend is important. If it is uptrend, then the investors which are trying to invest in the market can say, yes, the moment is uptrend, the prices are increasing, let us invest it. If it is in a downtrend, then the investors think, yes, that this is the downtrend, and let us sell the stocks of a particular company. Now, in this primary movement, there may be secondary movements. For example, this is for 1 year. We can say this March 2020. This is March 2021, 1 year. And this portion, again this portion, again this portion, these are secondary trends. These are secondary trends. This portion. And these secondary trends, that is, it has been increasing for some time, then it come down, then it increase for some time, then come down, then it increases for some times. It increases, decreases, increases, decreases, but the general primary trend is actually on the downward slope. So for longer term, the prices of particular stock has been decreasing. And these intermediate trends between the primary trend of 1 year are secondary trends. So it may be for a few weeks, or it may be for a few months also. So these are secondary trend. And what about the third trend? It is showing the daily fluctuations, or if we see the weekly chart, it will be the weekly fluctuation. So in general terminology, it is called the minor trend or a tertiary trend. So this, for example, on a particular date, the prices increase, it falls down, and then it increases again, falls down, increases again, falls down, increases again. But on a daily basis also there is a uptrend. The prices have been increasing. So these are basically the Dow Jones theory. That is primary trend, secondary trend, and the tertiary trend. Now, under this primary movement, also there are three phases. In this primary movement also, there are three phases. Three phases of both the bull market as well as the bear market. Let us see how. The prices are increasing slowly, not a very high uptrend, it is slight uptrend. So in this particular situation, the knowledgeable investors who are thoroughly researching the stocks, thoroughly, you can say, analyzing the price trends, start purchasing the stock of a particular company. So this is the investment by the you can say, knowledgeable investors. Now, when the knowledgeable investors starts investing, it will be shown in the charts. So the retail participation, the retail investors think that yes, the shares have been increasing. So they start purchasing. More investors will come in the market and they start purchasing. And they will keep the prices to a new high. So this is basically the second stage, the retail participation. Now, when a stock of a particular company, stock price of a particular company increases at a particular level, the investors think that yes, the possibility of further increase is not very much, so start selling it. And then the prices came down. So it creates a panic among other investors also, and then the fear psychology, the herd behavior, the human psychology comes, that they are afraid that the prices may further come down. So they also start selling. So in this, the prices starts to fall. The prices starts to fall slowly. So this is the selling takes place. So this is the end of the bull market and the start of the bear market. So that this is the, you can say, this is the bull market. First, the knowledgeable investor on the basis of thorough research start investing in a particular stock. For seeing this, the retail investors also come into the foray. They start investing, pushing the share prices to a new high. After reaching the new high, the general psychology is to pocket the profit. So they start selling the shares. When the knowledgeable investors or the general investors start selling, other investors also come into the foray and they also start selling. So the prices slowly was coming down. So this is actually the end of the bull phase and start of the bear phase. Bull phase, when there is an uptrend or the share prices are increasing, and the bear phase means the downtrend when the share prices are actually decreasing. So from here, further selling happens. The further selling happens. And when the further selling happens, sometimes, not always, that it creates a, you can say, panic, it creates a depression among the investors that the stock may not move further for a very long time to come. So the investor who were still holding it will also start selling. So it will be a distress sell. So it will be a distress sell. So this is the last phase of the bear phase. So this is the bear phase. Okay, but it may not happen all the time, because after getting sliding down movement further, if the potential of a particular company is good, it may also scale it further. But in case of some companies which are not very good, so it may come down to the distress price situation. So this is what the you can say DOW theory is. So according to the DOW theory, there are three movements: primary movement, secondary movement and the tertiary movement. In the primary movement may be a downtrend, or the primary movement may be a uptrend. Between these primary movements, there are secondary movements for a few weeks or months, and the daily fluctuations are known as the minor trends. And this primary movement has been divided into various parts. That is divided into two phases. You can say bull phase and the bear phase. Under the bull phase, the people starts purchasing. From seeing this, more investors come. When the prices reaches to a new high, they start selling. By seeing this, further selling happens. And if the prospect of the company is not good, then the distress selling happens further. So this is actually the end of the bear phase. So this is the end of the bear phase, the bull phase and start of a bear phase, and this is the completion of this bear phase. So this is what about the Dow Jones theory. Any questions on this? Okay. So let me see if I can, because there is this is a very important concept. It is Dow Jones theory. If I can take a practical example to you, if I give a practical example, let us take a practical example in this case. Let us take some other company, for example, Infosys. Okay. You see that this Infosys is showing an uptrend for a fairly long time to come. So this primary trend can be 6 to 8 months also, and it may continue for 1 year, 1.5 year, 2 years. So this is an uptrend. See, the prices have been increasing. Here it starts from about May 18/5/2021. The date is given below to you in the bold, and on this the prices were 1360, and it shows an uptrend and reaches here. The prices have moved from 1360 to about 1816. From the right hand side on the bold, in the black, the prices have been given that 1816. So it actually starts an uptrend from 1300 and reaches an approximately 1800. So 500 points, this is an uptrend. And between these are these from here to here. I will just explain to you. So this portion is actually the secondary trend. Okay. This portion. Then this portion. These are all the secondary trends. This one comes down, comes. So market always behave like this. It never goes like this at one go, or it never comes down like that. So it generally moves it upwards, then downwards, then upwards, then downwards. But general trend you can observe from this is the uptrend. The prices are actually going. This is a bullish sentiment. And between the bullish sentiment, these are the secondary trends. And the last trend is the tertiary trends, or the minor daily fluctuation, or you can say the minor trend. So on a daily basis, from this, I will just clear it so that I can explain this daily fluctuation to you. Here on this 18/5, the below, the date is given 18/5, and the right hand side, the prices are given, that is 1338 on 8th of May. On the next day, that is on 5th of May, on this 18th of May and on this 19th of May, that is on next day, the prices increased from 1342. So on 18th May it was 1338 and on the 19th it was 1340, about 2 to 3 rupees upwards. So these are actually the daily fluctuation. If we can see the major, can say uptrend, here it is on 26th of May, it is 1379, and on next day itself it is 1403. So about, you can say 20-25 rupees, you can say upward trend. Share price increases by about 20 to 25 rupees within just 2 days. You can see the 26th of May prices were 1384, and on the next day itself, that is on 27, the prices increased to from 1379 to 1404, near about approximately 25 rupees. So this way the daily fluctuations happen. This is the minor trend or the tertiary trend. Fine. Sairam is asking this is also applicable to cryptocurrency. Yes, Sairam, this is applicable to cryptocurrency also, because whatever this theory is given the technical analysis, and it can be applicable to stock also, and it can be applicable to cryptocurrencies also. Now come to the next very important theory, which is the Elliott wave theory. The Elliott wave theory is one of the most important theories, and it is near about 90 to 100 years old, and it is still practiced by the technical analysts because of its high, you can say, predictability rate. Generally, the technical analysts who follow this Elliott wave theory generally able to predict the market about 60 to 70% of the time, because market cannot be predicted 100%. So Elliott wave theory is a very important theory. Elliott wave was actually a very, you can say, supporter of the DOW theory. He studied the DOW theory. But after the stock market crash of 1930, he suffered heavy losses in the stock market. So he increases his research. He researched further into the technical analysis aspect and came to the conclusion that the technical analysis is not that complicated as it is made out to be. So he actually studied and he actually propounded a theory on the basis of which, on the basis of certain waves, or you can say on the basis of certain trends, it can be, you can say it can be predicted that whether there is an uptrend or whether there is a bullish trend, whether the share prices will move up, or is there a downtrend, that is the share prices will come down. So let us see what is this Elliott wave theory and what impact it can have on the technical analysis. How on the basis of Elliott wave theory the technical analysis can take a decision to buy or sell. So let us just go to the whiteboard again. Okay, now come to this Elliott wave theory. As per the Elliott wave theory, there are 5 trends on the basis of which the uptrend can be gauged, and after that there are 3 trends on the basis of which a downtrend can be made. So let us begin this. To see that the prices of a particular stock, it goes up, again goes down, because we have seen from the practical example that the market actually behave like this. It goes up, it goes down, again goes up, again goes down, and again goes up. So from the down, whenever you take a down situation from any part, and from here it goes up, then mark it as 1. It has been marked as 1. When it comes down, it has been marked as 2. And then the 3, you can see the 3 is actually greater than this 1. The length of this 3 is greater than the 1. So, and as per the Elliott wave theory, this 2 is less than the 1, this 3 is greater than the 1, and this 4 is also less than this 3. So this 3 actually shows a uptrend. Then another way to test is again goes down and again goes up. At this situation, you can clearly see that this is a uptrend. So generally what the technical analysts do is that at this position, they tend to buy because they can see that if there is an uptrend. So this uptrend will continue for some time. It can goes up this and continue for some time. But according to Elliott wave, when a technical analyst can take a sell decision, this is an uptrend, yes. So it will buy at this position because these previous trends, this previous high, for example, are generally surpassing this current high is actually surpassing the previous high. So this is a bull phase, this is an uptrend. So most of the technical analysts will buy at this point. But when the technical analysts will take a decision to sell, so it will go further also. Then in order to watch that, 3 bear market trends are considered by the wave theory. These are this is 6, this is 7, and this is 8. So here again from 5, it came down, again goes up, and again came down. But if you observe that this 7 is actually less than that of 5. So it means this is less than that of 5. So the investors can see that yes, this is the start of a downtrend. Again, this 8 is actually less than that because here the prices are here and it is here. For example, the price is here at about 100 and this is at about 90. So an investor and technical analyst can see that the prices are on the downtrend. This is actually start of a bear phase. So at this point, they will start to sell as soon as it breaches this level. As soon as this is breaches this level, that is the rupees 100. From this is an uptrend. You can easily observe that the 4 is higher than this 2, the 6 is higher than this 4, but this 8 is lower than this 6. Okay, so this is the start of a bear phase. And the technical analyst will generally resort to sell at this position. So this is what about Elliott wave theory is. It shows a certain pattern by 5 points, and on this first 5 points are indicator the bull phase, and he also indicated by 3 phases the bear phases on which the technical analyst will resort to sell. So this is what Elliott wave theory is. Any question on that theory? So any question on this? Fine. So I shall move forward. And this, you can see there are two patterns on this, impulsive patterns and the corrective patterns. So 1 to 5 is actually an impulsive pattern. Impulsive pattern because the share prices are on the increasing trend and more people are purchasing. There is impulsive buying because they see that yes, the prices are increasing. The greed factor, the basic human psychology comes in, and they also start investing in the share of a particular company. Corrective patterns means you can say the investors will start selling it because some of the investors are selling, prices are going down. So fear psychology comes, the human behavior of fear comes, and other investors also start selling. So that is a corrective pattern, the correction taking place. The prices shows a downtrend, or it is the start of a bear phase. Now, after this DOW theory and Elliott wave theory, which is random walk theory, and random walk theory has a contrary view in comparison to what the DOW theory and Elliott wave theory says. According to random walk theorists, the share prices in the stock market can never be predicted. What is the reason they gave? The random walk theorist. The reason they gave is that the price trends are not the result of any underlying factors. They actually represent a statistical expression. So the random walk theory simply says that the price trends do not repeat. They're actually a statistical expression and nothing else. I will give an example on which the random walk theory will be more clear to you. Let us say as a garment manufacturer, a big garment manufacturer, a fire broke out. And when the news of this fire broke out in the godown of this retail manufacturer went public, the share prices came down. It came down by 10% on a particular day. Next day, again, the share prices came down by 10%. Now, what happened in the second day? In the second day, the news broke out that whatever you can say garments or whatever garments were there in the factory were entirely burnt and nothing left. So the investors panic, they start selling, and then the share prices comes down further by 10%. But on the third day, the share prices increased by 5%. Why this is so? Why on the third day the share prices increases by 5%? The reason is that the news broke out that the company will be able to get most of the amount from the insurance company, which they have lost by this fire. So this was a positive news, and some of the investor which sold or the new investor starts purchasing, and the share prices went up by 5%. So what is the conclusion? The conclusion is that of the random walk theorist that the share prices respond to various news differently. So a particular news, the investors will respond to a particular news, and every news is a new news. So the past trends cannot be repeated in the future. So that is what the argument the random walk theorists generally give. And the third point, which is that there may be periodical ups and downs in share prices, but no connection can be established between two successive peaks and two successive lows. So this is the extension of the previous point that no connection can be established, means it is cannot be ensured that if the prices have been increased by such an amount, for example, 10 rupees, 15 rupees on a particular day, that may be repeated in future also. So this is no guarantee according to the random walk theorist. Okay. Now, we have taken these three theories, Dow Jones theory, Elliott wave theory, and this random walk theory. Now we come to the charting techniques, the various forms of chart. The first chart is the line chart. In line chart, lines are used to connect successive prices, and the closing price of each period is plotted as a point. So, and these points are joined by a line to form a chart, and the period may be the day or a week or a month. So in line chart, you can see the closing prices during a particular day. So let us understand this line chart. The line chart is actually, it shows the closing prices. It shows the closing prices. How it is shown? Practically it shows that here. The dots which I am making is actually the closing prices. So this is actually you can say a daily chart. This is actually a daily chart, and these are closing prices. For example, closing prices on first, closing prices on second, on third, on fourth, on fifth, on sixth, on seventh, on eighth, on ninth, and this is the closing price of the 10th day. So line chart shows the closing prices. On the basis of the closing prices, the technical analyst can make an assessment that whether this is an uptrend or whether this is a downtrend. So on the basis of this chart, he can make an assessment that yes, this is an uptrend, that because the prices are actually on the upside. Okay, so this is what a line chart is. Again, I will take a simple example to let you understand what line chart is. Let us take this NSE example, go to the line chart. So this, actually the line chart work like this, and with various points. This actually shows the closing prices of particular, this is the closing price on 30th. You can see the latest figure also. This is the closing price on 27th of October. And this is the closing price of this 29th of October. This is on 1st of November because Saturday, Sunday were closed. So this is 1st of November. This is the closing price on this 3rd of November and 4th of November. So these are the closing prices every day are shown in the line chart. Now this is basically a classic example of a line chart. And in this case, I want to just point out that this is not for any trading purposes. This is only for the academic purposes. So my purpose is to let you understand the practical aspects of the technical analysis and not to guide you on any trading aspect. Now come to the bar chart. Bar chart is also an important chart. In this case, besides the closing prices, the opening prices, the closing prices, the highest price during the day and the lowest price during the day, all informations are contained in the bar chart. So you can say the bar chart is actually an improvement over the line chart, because line chart only closing prices are there, but in bar chart, opening, closing, the highest price and the lowest price all are given. So let us first understand what the bar chart actually is. Now in bar chart, the bar chart is like this. And this, the right hand side actually shows the closing prices. And this left hand side is actually show the opening price. And this is the highest price during the day. This is the highest price during the day. And this is the lowest price during the day. Let us take an example. As you know, the market opens at about 9:15 in the morning and closes at 3:30 in the afternoon. So let us see the price of a particular stock opens at 100 rupees. See, open at rupees 100. It then reaches a high of about 120. Again reaches a low of about 90. And finally, during the day at 3:30, it settled at 115. It settled at 115. Again, the market opens at 9:15 at rupees 100. When the market opens at 900, the particular stock of this company is rupees 100. Then it goes up and reaches during 9:15 to 3:30 at 120 rupees. Then it again comes down at some point during the day at rupees 90. But after some purchase by the investor, it reaches to high, it get up further and closes at 115 at 3:30 in the afternoon. So this is the opening. So this bar chart shows the opening price, it shows the closing price, it shows the highest price during the day, and it also shows the lowest price during the day. So what will be your assessment as a technical analyst? On the basis of an assessment is that the price is on the uptrend because the market opens at 100 and it closes at 150. It means the price is on the, this stock is on the uptrend. This stock is on the uptrend, or you can say it is actually bullish. And these uptrend previously actually shows in white, and the downtrend, that is when the prices are going down, it was shown in black. So earlier it was used to show in white and black, means any uptrend, any increase in prices are shown in white, and any downtrend, any decrease in prices are shown in black. But now the technical analysts use different colors. The preferred color is actually green for the uptrend. Any uptrend is shown by the green color. It may be any other color also, but preferably it is shown as a green color, and downtrend is shown as a red color. And downtrend is shown as a red color. So this is what about the bar chart is. Now let us take an example. I have taken in the whiteboard. Let us say a practical example. See, this is Infosys bar chart. Take any bar chart and try to find out, let us say a good bar chart. This one 17th of August 2021. Below it is given, the date is given. So here on the right hand side, this is the closing price. This left hand side, this is the opening price. So in this Infosys on a particular date, that is 17th of August, the market actually opens at 17,006. It reaches a high of 1750. In the right hand side, in black, the prices are given 1750. During the day, it reaches a low of 1686, and again it is closed at 1741. So whether this is an uptrend or a downtrend, it is clearly an uptrend. Why? Because closing prices are more than the opening prices. So there is an uptrend or a bullish trend when the closing prices are more than the opening prices. And whenever there is a downtrend, a bearish trend means the opening are more than the closing, means the market has been closed at lesser than the opening. Then you can say it is a downtrend, but it is an uptrend, because see here on this 17th of August, the market opens at about 1703 and it closes at 1740. So 1740 minus 1703, about 37. You can say near about 40 rupees gain during a particular day, that is on 17th of August 2021. So this way, on the basis of the bar chart, the analysis can be made. Yes, on a particular day, this is an uptrend and this is a major uptrend, 40 rupees gain in a particular day. Okay, fine. So let us get along. Now come to the second charting techniques, in fact third charting techniques, the Japanese candlesticks. The Japanese candlesticks are similar to bar chart in the way that whatever information is there in the bar chart is there in the Japanese candlestick also. The opening prices are given in the Japanese candlestick, the closing prices, the highest prices, the lowest prices. But the Japanese candlestick chart are generally more preferable or generally most preferred by the investors. There's a reason behind it. What is the reason? The reason is that it is actually very user friendly and it also shows a particular, you can say, a trend which is called a doji, D-O-J-I. Doji is a market trend in which the opening prices and closing prices are equal. So let us see. I will take a practical example so that you can understand this Japanese candlestick straight away. So these are actually Japanese candlestick of Infosys Limited. Let us take a candle on a particular day. Let us take this, a prominent green candle. As I have mentioned that the green ones are the bullish ones, uptrend, that is in which the closing prices are more than the opening. And this red ones are the bearish ones. This is downtrend. It shows the downtrend. Downtrend means the opening prices are more than the closing prices. And here the green one, this is closing are more than the opening. So this is where the market opens here. This end of the candle on this particular day, that is 17th of August 2021, the same date on which I have taken the example of a bar chart also. So market opens at 1704, reaches this high. This is the high of 1747, reaches a low during the day at 1687, but finally closes at this 1743. So the market actually increases during the day. This is a downtrend. Again, this is the closing. This is the opening. This is the candle, highest price, and this shows the lowest price during the day. So the market opens here, opens at 1074 and closes at the market opens at 1701. You can say the market opens at 1705. You take 1705 and it closes at about 1741. You can say 35 to 40 rupees gain in a particular day. Okay, so this way the Japanese candlesticks are generally observed. Now, what I've said that one of the advantages of this Japanese candlestick is the doji candlestick. Let us find if we can find a doji. Here, the date is 28 June 2021. And the black is below here. And at this date, the price is on the right hand side given to you, 15 in the black, that is 1574.32. So on this day, the opening price is equal to the closing price. So doji candlestick shows that the opening prices are equal to the closing prices. What it means? It means that the market on this day, that is of 28th of June 2021, the market opens at 15. The Infosys, the market price of Infosys opens at 1574. It slightly moved upwards, reached a high of 1574 to 1579. Again, it comes down at 1564, but finally closes at 3:30 in the afternoon at 1572. So it opens at 9:15 on 1572 and closes at 3:30 in the afternoon at 1572. So this is a doji candlestick, and doji candlestick, what it signifies? It signifies that there is a tussle or there is a fight between the bull and bears. So the market is not going anywhere. So on the basis of doji, no decision can be taken because it does not show any pattern. It neither shows a uptrend, a bullish trend, neither it shows a downtrend or a bearish trend. So you can say that the Japanese candlesticks, on the basis of information, the Japanese candlesticks provides all the information as the bar chart provides, but the Japanese candlesticks are more user friendly, and doji candlesticks can also be seen from the Japanese candlesticks, in which the opening prices are equal to the closing prices. Now let us move forward and move to the last section of this charting techniques, which is point and figure chart. Now this point and figure chart is slightly more complicated than the line or bar charts. Actually, they point and figure charts are generally used to find out or detect the reversals. Reversal means if the price is on an uptrend, then how to detect that the prices are come down. So prices then after an uptrend, if the prices come down, then this is a reversal. In the same way, if prices are coming down, then when the prices are going up from a down, it shows a reversal. So reversal can be interpreted in both ways, in an uptrend also and in a downtrend also. Now, for plotting a point and figure chart, you have to first decide the box size and the reversal criterion. Generally, the accepted reversal criterion is generally is 3. That is 3. That is, when the prices are showing an uptrend, X is plotted, and when it is on the downtrend, O is plotted. So for the uptrend, X is plotted, and for the downtrend, the O is plotted. And the box size may be taken, it may be 1 rupees, it may be 2 rupees, it may be 0.5, and reversal criterion accepted is 3 rupees. For example, the uptrend is from the prices moving from 5, 6, 7, 8, 9, 10 rupees. And from 10 rupees, it falls to 7 rupees. So the downtrend is 3 rupees less. So when it falls by 3, the O will be plotted. So there should be a gap of 3 in order to plot, you can say gauge a reversal. So let us take a practical example, which is given in your, I would say, share the study material. The example which is given on the study material is very good, and you will be able to understand this by going through this and whatever I have just explained to you. Now, in this case, period 1 to period 10. Okay. And if you observe closely, the prices are on an uptrend. Okay. Because it is increasing 24, 26, 27. Then on the 5th day, it is coming to 28. And after that, there was a slide. Then 27, 26, 25. And lastly, on the 10th day, it is coming to 23. Now, how to plot that? As I have said, that uptrend is plotted by shown as X and downtrend are shown as O. So when it is showing an uptrend is generally starts from 24. So X is plotted in front of 24. Then the prices increases 24 to 26, but generally the margin is taken as 1 rupees. So 24 to 25, X is plotted. In 26, again X is plotted because it increases to 26. It increases to 27. Again X is plotted and then reaches at 28. Again X is plotted. Now, how to plot the reversals? Reversal, or in this case, the reversal is a downtrend. The downtrend, the gap will be ₹3, which is generally the accepted practice. Now, ₹3 means it reaches a high of 28. So 28 minus 3, it will be 25. So on 25, the downtrend or the reversal trend will be plotted by showing O. So here it is showing, in 25 it is showing O. Then again 27 minus 3, it is 24. So in front of 24, O is plotted. Again 26 minus 3, it is 23. So in front of 23, the O is plotted. So there is no further decrease after 23. So we will stop after that. So this way the point and figure chart is actually shown. So I hope it is clear to any question on this chart. So under these charting techniques, we have actually started from the line chart, in which the closing prices are shown. Then we come to the bar chart, in which not only the opening and closing prices are shown, but the highest price during the day and lowest price during the day are also shown. Then we come to Japanese candlesticks. In Japanese candlesticks also, all the informations which are there in the bar chart are shown, but the Japanese candlesticks are generally followed more by the technical analysts because of their user friendliness. And doji candlestick is also shown in the Japanese candlestick, in which you can easily find that yes, this is a doji in which the opening prices are equal to the closing prices. And the last of the charting techniques we have discussed is the point and figure chart, which is slightly more complicated, and it is shown by X and O, and uptrend are shown by X and downtrend are shown by O. And generally the reversal, the gap between two reversal is ₹3. Okay, Sairam, which portion you want to repeat? Sairam, if you are listening to me, which portion you want me to repeat again? So these are the various charting techniques. We have started with line chart, then bar chart, then Japanese candlestick, and the point and figure chart. Okay, so shall we move forward? Now come to the various market indicators. Under the market indicators, the first indicator is the breadth index. So what the breadth index tells? So breadth index tells that, okay, fine. Before, let us see the point and figure chart again. Let us see. In point and figure chart, in this case, you observe the question that the prices are actually increasing from 1 to 10 periods, because from first day to 10th day, the prices are increasing from 24, then it increases from 24, 26, 27, 28. Now, in point and figure charts, the uptrends are shown by X and the downtrends are shown by the O. So, when the uptrend is starting, this is starting from ₹24. So in front of 24, the X is plotted. Then again, after 24, it is showing an uptrend till ₹28. So from 24 to 28, X will be plotted. So 24X, 25, 26, 27, 28. Then we will have to find out the reversal, when the trend reverses or when it is a downtrend. So downtrend starts from this 26, 25, 26. But we have to, in point and figure chart, the reversal may be taken as ₹3, 5 rupees, 7 rupees. It is up to the technical analyst. But the general accepted practice is 3 rupees. Means if the prices fall by 3 rupees, then we plot a O. Let us see if the prices fall by 3 rupees. The market reaches the high of 28. Okay. And if we deduct 28 minus 3, it is actually 25. So when it actually comes down by 3 rupees, O is plotted. So gap of 3 rupees is taken. This is actually done so practically because you can say that yes, this is a major reversal. Prices reverse, the prices have come down by 3 rupees. And again, from 27, you deduct 3. It is 24. From 27 to 24, there is also a 3 rupees down. So O will be plotted in front of 24 also. And after that 26, it reaches to 23. So 3 rupees deduct reversal. So 26 minus 3 will be 23. So O will be plotted in front of this 23 also. Okay, so this way the point and figure chart is actually done. So it is slightly complicated, as I have said, in comparison to the other charts, but I hope now it is clear to you. Okay, fine. Now let us move forward and go to the market indicators. We will discuss some of the various market indicators. The first indicator is the breadth index. Under breadth index, the securities traded is computed, covers all the securities traded. And how the breadth index is calculated? It is computed by dividing the net advances or declines in the market by the number of shares issued. And this index is generally used to determine the volatility. In this case also, let us take an example. Breadth index. So breadth index is shown by, you can say, or I will take it here. Net advances divided by number of shares net advances upon number of shares traded, or it can be shown as advances minus declines divided by number of shares traded. Now, what this breadth index signifies? Breadth index tells about the volatility. How? Say advances of a particular stock, you can say 30 stocks have advances and 15 stocks have declined. So you can say that this is volatile. On the other hand, if 15 stocks advances and 15 stocks decline, you can say this is stable. So this is what the breadth index tells about. It tells about the volatility. Okay. Now let us take a small example in case of breadth index so that it can be more clear to you. So I am just sharing it. Let us. I hope it is visible to you. Increases the font. Just give me a second. So this is the Nifty 50 equity stopwatch, and if you see that on a particular day, the date is given, that is November 4, 2021. The total advances, Nifty 50 means 50 stocks. The total advances are 39. The total declines are 10. And same result is 1. So out of 50, there are 39 advances. What it means? It means that the market is volatile. So this is actually an example of, you can say, breadth index. We should increase the font so you can understand it. This is on 4th of November. The advances are 39 and declines are 10. So let us back to the PPTs. Now, volume of transactions. This volume of transactions, guys, is also very important because the volumes tells that how the market is behaving. A rising price index, for example, if the Nifty is rising, if the BSE is rising, what it tells? It tells that it is an unsatisfied demand in the market. Means the share prices are increasing means the more people are want to purchase, and it is goes on increasing and increasing and increasing. So this is an unsatisfied demand in the market, and it is basically a bull market. Similarly, in a falling market, if the volume increases, it shows a bear market. That is, the prices will expect to fall further. So volume plays a very important role. If the prices are increasing in case of a particular stock, and the volumes are also increasing. So volumes are increasing means the more people are trading, more and more people are buying. So the volume of transaction is more. So it means that the uptrend will continue for some time. In the same way, if the market is coming down and the volume is more, means more and more people are trading, it means it is a bear market and prices are expected to fall further. But if the prices are increasing and then the same way the volume of transactions are not increasing, it means that there is something wrong. So volume is very important. So when the technical analyst trade, they generally see that the volume in a particular stock is good, whether it is an uptrend or whether it is a downtrend. Now come to another very important market indicator, that is confidence index. What is the confidence index and what it tells, and how confidence index affect the stock market? Now let us understand this. Confidence index is the ratio of high yield bond yields to low grade bond yields. A rising confidence index is expected to precede a rising stock market, and a fall in index is expected to precede a drop in price. It means if the confidence index is high, the stock market is expected to do well. And if the confidence index is low, the stock market is generally will not do well. Now let us understand this confidence index. I will explain you with the help of the whiteboard. Confidence index. Let us take a situation when the confidence index is high. When the confidence index is high, so it generally shows stability. If the confidence index is high, it is generally shown stability. First, write it the formula, because this is yield on this high grade bonds divided by yield on low grade bonds. Yield on low grade bonds. Okay. So confidence index is yield on high grade bonds upon yield on low grade bonds. Now, if confidence index is high, it shows the stability. Stability where? Stability in the economy. Stability in the economy. And it also shows that the economy is showing signs of recovery, or the economy is likely to do well. Now, take an example, a recent example. What happened during the COVID? During the COVID, after the pandemic, most of the sectors actually suffered, either because of lockdown or because the huge layoff among the laborers. Actually, some of the small companies are not able to pay their, you can say, their staff, and many companies suffered because of that, and many companies also were actually closed. So there was a, you can say, huge impact on the economy. Economy was not doing well. In order to boost the economy, or in order to enable the companies to do well, in order to provide money or funds in the hands of the companies, what the government do is, the government starts to borrow. The government starts borrowing. The government starts borrowing by issuing bonds. The government starts borrowing by issuing bonds, and this huge borrowing leads to more supply of bonds. More supply of bonds. So more supply of bonds leads to rising bond yield. And the rising bond yield was because of the investors who invested in this bond issued by the government. These are very large investors. These are actually banks, insurance companies, mutual funds. So government is in need of money. So they provided it, the various investors provided it, but by charging some interest, they get more return. They can negotiate for more bond yield. That is why the bond yield actually increases. So when the government starts issuing more supply of bonds, and the bond yield actually increases. So what does create? It injects huge liquidity into the system. Liquidity in the system, in the economic system. So liquidity increases means there was more money in the hands of the people, or the people who are doing business, because whatever government starts borrowing and then pushes it into and invests in various sectors, it given a huge boost to the various infrastructure sector, that is modernization of the various railways, airports, seas, highways. It started the production linked incentives, in which the domestic manufacturers get some incentives for manufacturing in the domestic sector, manufacturing anything domestically, mobile phones, computers, you can say in the textiles. These are getting the incentives, or you can say from the government. So funds and monies are provided to the various sectors. Okay. So various sectors are likely to do well. So these various sectors are likely to do well. When when various sectors are likely to do well, the investors which are in the stock market generally will be optimistic. Investors will be optimistic. Investors will be optimistic, and they will actually start investing in stock market. Start investing in the market. So this will actually pushes the market, because more and more people will start investing in the market. That will actually pushes the market to a new highs. So this is what happened. If the bond yield is high because there is liquidity in the system and the government is actually, you can say the economy is either expected to grow or there is a chance that the economy will grow further. So high bond yield shows that the economic outlook is good. If the economic outlook is good, then the investors are generally willing to invest more in the stock market. So actually the rising bond yield is actually good for the stock market. The rising bond yield actually, high grade bond yields is actually good for the market. Now what should be the criteria? Generally, the yield on high grade bonds is less than the yield on low grade bonds. But this difference should not be more. Say it is 7.25 in case of high grade bonds and 7.75 in case of low grade bonds. So this is basically coming to about, I am giving an approximate figure, 93.5%. Now take another scenario in which the yield on high grade bonds is 7% and yield on low grade bonds is 8%. So approximate figure which is coming is 87.5%. Which is not so good. So this is yield on high grade bonds is high. You can say that it is good outlook for the economy, as we have explained that how it is good for the economy, this rising bond yield. And if the economic outlook is good, generally the investor will tend to invest more in the stock market. So this is what about this confidence index. So I have discussed this confidence index. Let us move forward. Now come to relative strength analysis. What this is? Relative strength analysis says that a price of a particular security, a price of a particular stock generally rises faster in comparison to other stocks. In the same way, this is for bull market. In the case of bear market, the prices of a particular stock falls more faster than the market or in comparison to any other industrial sector. So investor will earn higher returns by investing in the securities which have demonstrated relative strength in the past, because the relative strength of a security tends to remain undiminished over the time. So in technical analysts generally take advantage of this relative strength. Now let us understand what this relative strength is by giving a simple example and how you can say the technical analysts take advantage of this. Okay. This is relative strength analysis. Say, take a simple example of a particular sector. Say automobile sector. In the automobile sector, in the past 1 month, it has increased to about 2 to 3%. So 2 to 3% increase in last 1 month. This is the automobile sector. 2 to 3% increase in the last 1 month. But a particular company in this automobile example, I am taking a hypothetical situation. For example, in case of Eicher Motors, say the increase during the last 1 month is 5%. It is 5%. So Eicher Motors is giving more return in comparison to the other automobile sector. So you can say that the stock of Eicher Motors is a relative strength. This is a relative strength in comparison to other companies. In comparison to other companies. So on the basis of this, the technical analysts take decision. What is the advantage for the technical analyst? A particular stock which has a relative strength more in comparison to other companies in the same sector, they actually tend to invest in such companies because they think that yes, the relative strength is more, so their uptrend will likely to continue for some more time. And this trend may be repeated in the future also. Okay, now let us move forward and come to odd lot theory. Now, odd lot theory is a theory in which the it is you can say an opinion among the various knowledgeable investors who give a thorough research into this technical analysis and studies the chart and the graphs very carefully and compare it with the previous trends, that the average person is usually wrong, and the wise course of action is to take or pursue a strategy which is contrary to or which is opposite of the popular opinion. As I have discussed before in this session, that there are both type of investors which actually causing the uptrend, that is a demand, or causing the supply, that is a downtrend. And these are both rational as well as irrational investors. So most of the retail investors or general investors generally behave irrationally most of the times because they do not undertake any thorough research, and they simply act on the basis of any tips given by his neighbor or his friend, or he thinks that a lot of people are purchasing, I should also purchase it. So this is sometimes the decision is taken on the basis of pure, you can say, instinct or pure intuition, not on the basis of any research on the part of irrational persons. So the rational persons generally act contrary to what the irrational persons are thinking. So they purchase a particular stock, or they took a decision to exit a particular stock on the basis of their thorough research and analysis of the technical charts. So basically, the odd lot theory is used to predict the tops in bull market, but also predict the reversal in the individual securities. Now come to another very important concept in the technical analysis is support and resistance. So if you must have heard that in the various newspapers also and in the various news channels also, this term support and resistance is used many times. So what this support and resistance is, and how the technical analysts take advantage of this support and resistance while trading. So let us see. Support and resistance. Now take a hypothetical situation. The particular stock, or you can say the market NSE, moving like this. Okay, so this way the market is behaving. So what is support? Support means the level, the price level from which the prices will not fall according to the technical analyst. So this portion, you can say that this portion is actually the support level. This portion is the support level or support level of price. Support level of price is the level at which prices are not likely to fall further. Are not likely to fall further. This is the support level. If you see that the prices from here have gone up, and come down, but does not breach this level. Again, it is gone up, come down, but does not breach this level. It does not come below this. Again, gone up, come down, does not breach this level. This happens a number of times, you can see. 1, 2, 3, 4, 5. This situation you can also take. So 5 situation. A particular time period, say it is about for 6 months. Say for 6 months. So for if this is a 6 months trend, then the prices have reached a particular level. For example, this is rupees 100. Let us take this 100. So whenever it reaches rupees 100, during the last 6 months trend is that it does not fall below 100. Whenever it reaches 100, it goes up. Whenever it reaches 100, it goes up. Whenever it reaches 100, it goes up. Also here, whenever it reaches 100, it goes up. So this is the support. So on this basis, the technical analysis can make a prediction or can make a decision that yes, the prices are not likely to fall further. Now let us understand the resistance. Let us try to understand the resistance. Resistance is the level from which the prices will not go up. So it creates a resistance, means resistance to the prices to go up. So if you see the level, let us consider this level as 200. Okay, whenever the prices reach 200, it doesn't reach this level, it comes down. Again reaching 200, come down. Reaching 200, come down. Again reaching 200, coming down. Here also it reaches 200, come down, reaches 200 and then come down. So for the last 6 months, the technical analysis can very well say that this is the level below which the prices will not increase. That is, resistance is the level, price level at which the prices are not likely to go up. So we have seen the trend of the last 6 months that whenever the price reaches 200, it falls after reaching 200. So this is the resistance. The resistance to go up. So support is the level at which the prices are not likely to fall further, which is the 100. This is the support level, and resistance is the level at which the prices are not likely to go up. This is the 200 in this case. So this is in many cases, the stocks generally trade between this support and resistance level. It does not hold true always, but some of the times, in some cases, most of the situation, it trade between this, generally move between these two levels, support and resistance. So what is there for the technical analyst? So what decision they will take on the basis of this support and resistance. And another thing is that this support and resistance does not hold true always. The market always creates a new support and new resistance. It may happen that after 6 months, it will fall further from this. And after reaching this, it may go up. So the market may always create a new support and a new resistance. But when a support and resistance is created, most of the time it continues for a fairly some time to come. So what is now my question? What is there for the technical analysis? What decision they will take? Whenever the prices reaches the support level, what is the support level? The prices will not fall below 100. So at this level, the technical analysts are likely to buy because they know that there is very little chance. It may fall below 100, but the chances are that it will not fall below 100. So at this level, the technical analyst will buy. Now, if the prices reach the resistance level, for example, it reaches 200, what will be the, you can say, decision of the technical analyst? The technical analyst or the trader in this case will actually sell at the resistance level because he knows that the prices will not go beyond 200. So it is no use to hold the shares. If the chances are that the prices will not go beyond rupees 200, it is better to sell the shares. So on the resistance level, the shares are sold, and on the support level, the shares are bought. The stocks are bought. So this is what the basic concept of support and resistance. I will try to take possible practical example in this case. Just take some other company, not Infosys. Take South Indian Bank. Here, if you see, actually, I have shown you this example because the market actually does not behave in the way I have drawn the diagram. I have drawn the diagram in order to make you understand the concept. But practically, the market behaves like this. So it has created a support at about 8. So market moves, fall below, and it does not fall below rupees 8. It again goes up, fall, but here does not fall below rupees 8. Okay, again goes up, fall, does not fall below rupees 8. Again goes up, fall, but does not fall below rupees 8. 8.24, but does not fall below, did not fall below 8. Again fall near about 8. So you can say from here, from you can say December 2020 and till the present situation. It has been since 1 year till the present situation. I will take the present situation also. This is November 2021. It didn't fall below 9, below 8 up till now. So at 8, it has created a support level. So from whenever the stock price reaches 8, as a technical analyst, one can easily assume, yes, that below 8, the prices will not fall. So let us purchase that this price at rupees 8. So this is an example which I have given in case of this support. And let us try to find out the example in case of a resistance. Okay. Let us take a company, large cap company. Let us take Hindustan Unilever Limited. Now, Hindustan Unilever Limited go to slightly previous years. from 1999 onwards. So if you see that from 1999 onwards, here the below it is given. It is actually a yearly chart. Okay. So if you see that this Hindustan Unilever Limited is actually creating a support at around 260. So resistance at around 260 to 270. Means whenever the prices reaches 260 or 270, it does not go beyond that. Here 270, it goes down, goes up, reaches near about 270, again goes down, again goes up, again goes down. Doesn't breach the 270 mark. Here it breaches the 270 mark, but not by much, 277. Again, it goes down, goes up, 257. It breaches here only, breaches 80. So you can say the resistance is created between 260 to 280 for as long as from 1999 to 2009, means about 10 years. So this resistance between rupees 260 to 280 has been created for about 10 years. So as an investor, if you know that, yes, the prices have reached 260, 270, at the most 280, it is better to sell the share because very little chance that the prices will go beyond 270 or 280. So this is what the resistance is all about. So Yatin, you are asking about the Heiken Ashi chart. It is also a Japanese candlesticks. Heiken Ashi I have used because actually it is more user friendly and the gaps are not showing. In ordinary chart, actually the gaps are showing. If I show this candlestick, the gaps are showing. Therefore, I have taken the Heiken Ashi. So Heiken Ashi is nothing but actually it is a Japanese candlesticks. The presentation is different only. And it is actually showing the average of the previous and the present day. Okay. So I am just stop sharing it. I will now actually support and resistance are clear. Let us get to the PPTs again. Okay. So I've taken some time to discuss this support and resistance because this is a very important concept in this technical analysis. Now come to the price patterns. How there are various price patterns we will now study and how to interpret this price pattern, what it shows, what it indicates, a downtrend or a, you can say uptrend, what it is. First is channel. What is channel? Channel is actually uniformly changing tops and bottoms. It either showing a downward slope channel or a upwards channel. Let us take an example to understand this. I will stop sharing it. Okay. Let's take a particular price trend. Just get me to the, okay. Let us discuss the channels first. So channels will either show the uptrend or it will either show the downtrend. The uptrend may be this is the uptrend. This is the uptrend. Here the prices go up, down, up, down, up, down, up. And if you see that every up has been breaching the previous up, okay, from here to here, then again, so it is a clear uptrend. And this uptrend is generally shown by this is a N formation. If you observe it closely, this is a N formation, or this is you can say uptrend or a bullish trend. In the same way, downtrend can also be shown by way of a channel. Downtrend may be this. So this is a downtrend, and it shows a reverse N formation. It is called a reverse N formation or M formation, if you observe it. So this is actually a reverse N formation or M formation. And for technical analyst, what it shows a bearish trend. It shows a bearish trend, means the prices will likely to come down in the future. So this is what channel is. Easy to understand. So let us understand quickly how it happens practically, this channel. See, this is an uptrend. This here, come down, goes up, down, goes up, down, goes up, down, again goes up. So here, actually, this is creating a uptrend. This is creating a uptrend. You see that? It's creating a uptrend. Let us take a downtrend. Same way, any other company. Let's take an example of Apollo Tires, and if you let us see that if we can find any downtrend. Yes, we have found a downtrend. Here the market reverses. If you see from here onwards, this come down, goes up, again down, goes up, again down, goes up, again down, goes up, again down. So it's coming down fairly for a long time. So it is here, it goes down from about 2018 to 2020, 2023. So about 2 years, near about 2 years, it is showing a downtrend, this Apollo Tires. See, and it is showing a reverse N formation or a M formation. The very prominent and very, you can see, visible, that is reverse N formation or a downtrend, on the basis of which the investors or the technical analysts, the traders, can actually take a decision that it is a downtrend, is whether a bearish market, price decrease will continue for some time to come, and they will start to sell. So again, I will stop sharing it here. Let us get to the PPTs again. Fine. Now this formation is actually wedge. So wedge is formed when the tops and the bottoms change opposite direction, and that is if the tops are decreasing, then bottoms are increasing, vice versa. Means if the tops are increasing, then the bottoms are decreasing. And this is a very and wedge is also shown when there is the particular market is creating a new high or a new low, or creating a new resistance or creating a new support. On such situation also the wedge is shown. Wedge is basically, and it will show in the form of wedge. What is wedge? Wedge is actually the golf club. If you have seen that, the golfer used this, the stick, which is there in the golf, it is in the shape of a wedge. So it will come to that shape if there is a huge difference between the tops and a bottom. Let us take a practical example. Okay. Now take another company which has been in news in recent times. You'll find it interesting. Z Entertainment. So in what has been happening in the Z Entertainment? See, if you see it, the market is actually creating a new support, new resistance, tops resistance. So it generally comes in the shape of a wedge. The shape will come like this. The shape will come like this. The shape will come like this. Just give me a few seconds. So it will somewhat come like this. So this is the shape of a wedge. Now I want to take another example so that it is clear to you. Z Entertainment top, sudden top. This is a new top and a new bottom. Let us take another example. In order to understand this, let us take example Hindustan Unilever itself. See, this is a wonderful wedge formation in Hindustan Unilever Limited. See, this is creating a new high, the tops and the bottoms. So it is also creating a shape of a wedge. It is also creating a shape of a wedge. Here. Here. Near about it is creating a shape of a wedge. So I hope this is clear to you. That is channel and wedge. Let us take to the next. Head and shoulders. Head and shoulders guy is also very important, and it is also a good, you can see, price indicator, and it is used to actually predict that whether the price will increase or the stock prices will come down. Now let us understand this head and shoulders, because it is generally considered as a very important, you can say, a price indicator. This is head and shoulders. We'll stop sharing here. This is head and shoulders and also inverted head and shoulders. Let us take both of this, head and shoulders and inverted head and shoulders. Head and shoulders. So this is the head. This is the head, and these are the two shoulders. This is the head, and these are the two shoulders. Generally, head and shoulders indicate a bearish development. See here, it is called the neckline. It is called the neckline. So whenever the next downtrend is below this neckline, it is the time for the technical analyst to sell the shares, to sell the stocks. So this is what is head and shoulders is. Now let us understand inverted head and shoulders. Inverted head and shoulders. This is the inverted head. So this is the head. This is the head. This is one shoulder, and this is the another shoulder. It is inverted. Here the head is above in the top, and here the head is in the bottom. So it is inverted head and shoulders. So what inverted head and shoulders indicate? The inverted head and shoulders generally indicate a bullish trend. How? See, this is the neckline. This is the neckline. Whenever the next uptrend is above this neckline, it is the time to buy. Okay, so this shows the bullish trend. So what is this difference between head and shoulders and inverted head and shoulders? Yeah, the head and shoulders show the head is in the top. There is one head and there is two shoulders. Generally, head and shoulders is used by the technical analyst to predict the bearish signal. So in this head and shoulders, if the downtrend is below the neckline, a neckline is drawn below this neckline, it is better to sell. It is showing a bearish outlook that the prices will go down further, indicates. What about inverted head and shoulders? In inverted head and shoulders, you see the head is below and the shoulders are above. So this is the head, and these are actually two shoulders. These are actually two shoulders. And the inverted head and shoulders are shown a bullish trend that the prices will go up. How? Here a neckline is drawn. So you see the second uptrend. The second uptrend is above the previous uptrend. So it generally shows a bullish indication. It indicates that the prices will go up further. So head and shoulders indicate a bearish trend, and inverted head and shoulders indicate a bullish trend. Okay guys, any question on this head and shoulders and inverted head and shoulders? Let us take one simple example. Let us go to another company, Apollo Tires. Let us see. Sorry. Apollo Tires daily chart, and let us able to find out whether they able to find any head and shoulders. Yes, hidden. There is a head and shoulder here. There is a head and shoulder, maybe not a very prominent head and shoulder, but it actually the head is upwards. There are two shoulders, and it is showing an uptrend. It is showing an uptrend. It is showing an uptrend. Here also, it is an, you can say, a head and shoulder, and this is also where it is an uptrend has been shown. Let us, I point it out, this head and shoulders. Here, it is showing down, going up. This is the head, this is the shoulder, and then it reaches this previous. You can say, you can draw this neckline. This is the neckline. So whenever it reaches this neckline here, whenever it reaches this neckline, it's time to buy for the technical analyst, or it shows actually a bullish trend. Okay. So I will stop sharing it, and I will take one example of inverted head and shoulders also. Let us take another company. Let us take DOW India. And DOW India daily chart, if we show whether we will be able to find any inverted head and shoulders or not. Yes, this is an inverted head shoulders. We can find here itself. Goes up. This is create a head, shoulder, and it goes up. So this is a very good, clear inverted head and shoulders in case of DOW. See, this is goes up, goes down, is a head, again creating a shoulder, and then goes high. This actually previous high is above this high. So this is actually showing an uptrend. This is actually showing an uptrend here. Okay, just give me a second. I will just clear it. And let us move to the PPTs again. Now we understood what head and shoulders and inverted head and shoulders are, and how the technical analysts take decision on the basis of this head and shoulders and inverted head and shoulders. Now come to triangle or coil formation. Triangle or coil formation means the market is in a consolidation phase. The market is in a consolidation phase. And it is difficult to predict whether the market will go up or whether the market will go down. Let us see a simple example, because triangle coil formation are very easy to find the consolidation stages. Let us see a stage where there is a consolidation. or take another company, some other company. Let us take ITC Limited. Here, in ITC, if you find that there is a very clear sign of this, you can say triangular coil formation. So triangular coil formation shows a confusion. That is confusion among the bulls and bears, whether the prices will increase or whether the prices will go down. Here, the prices come down, go slightly up, coming down, up, down, but it is similarly in this almost in the same level. So it is from this 28/12/2020 to 28/12 to 6/9/2021. This period, actually, this December 2020. So this December 2020 to this September 2021, for about 9 to 10 months, it is showing a triangular or a coil formation, or a, you can say, it is called a consolidation phase. Consolidation phase means that is the market is going nowhere. Neither it is showing a uptrend nor it is showing a downtrend. So this is a classic example of, you can say, a triangular or coil formation. So I will take go to the PPTs again. Now come to the flags and pennants. So what are flags and pennants? Flags and pennants show that whatever the previous trend are likely to continue in the future also. This is the flags and pennants. Let us take quickly the example of a flags and pennants. So let us see the flags and pennants. In case of say another company, let us take Axis Bank. Let us take Axis Bank, and in case of this Axis Bank daily chart, let's see. Just give me a second, please. Just give me a second. Okay. Now, in Axis Bank, let us find out whether there is a previous trend or not. Here, it is the trend is almost similar, this, and it has been repeated here also. I have taken this example earlier also. See. See. This is the trend, and it has been repeated here also. Not exactly same, but the trend is more or less similar in the previous trend. I have explained this when I was discussing that yes, the past trends are repeated in the technical analysis. So this is flags and pennants. Flags and pennant means previous trends are generally repeated in the future. Fine. So let us go to the PPTs again. Now come to a double top formation and a double bottom formation and a gap. I will take few minutes to explain this, what is double top formation and what is a double bottom formation. So I'm stop sharing here and goes to the whiteboard. So this is double top and this is double bottom. Double top means there will be two top. Let us take a example. Let's take a example. And this double top formation generally indicate a bearish trend. This double top formation generally indicates a bearish trend. Here, in this line, this is the line. If the next low is lower than this previous low, here, previous downtrend, then this is where the technical analysis will wishes to sell at this position. Now, let us take example of double bottom. So, double bottom is generally indicates a bullish trend. Double bottom indicates a bullish trend. And when this current high surpasses this previous high, then it is to sell, then it is to buy. Then the decision of the technical analyst will be to buy. Let us take a practical example. For example, here it has from bottom it reaches to rupees 100, and it again goes up, goes down, and then again shows us an uptrend. And this current uptrend is more than the previous uptrend. Say it is about 110. So at 110, the technical analyst can very well found out that now since this present uptrend is more than the previous uptrend, it is better to buy the shares of a company. It is a bullish trend. In the same way, in the double top formation, it is gone up from rupees, we can say rupees 50 to gone up, gone down, gone up, and then again gone down. And this current downtrend is below this previous downtrend. For example, it goes to about 40. So, as a technical analyst, you know that it is the share, particular stock is on the downtrend. It is below the previous trend. So, the decision will, in case of most of the technical analysts, will be to sell at this situation. So, double top, bearish outlook, and this double bottom is actually the bullish outlook. Okay. Let us just quickly see a bullish development. Double top, double bottom, both. Let us take iShares Motors, which I have taken previously also. Here. This is the double top. Two tops, double top. Here, it goes up, down, goes up, again goes down. And this level is actually below this previous level. And you can say this double bottom also goes down, goes up, goes down. And this uptrend is actually higher than this previous uptrend here. Because here the prices are 2727. Here the prices are about 2743, and now it has breached this 2743. It is now 2777. So this is an uptrend. So trend is bullish, and the decision of the technical analyst in such situation will be to buy the shares. So this is the double bottom formation, bullish, and double top, bearish. Now, come to the gap. What is gap? Gap is the difference between the opening price on a trading day and the closing price of the previous day. Wider the gap, the stronger the signal that whether the trend will continue for a while or not. So in case of a bullish trend, if the difference between opening and closing is high, then it indicates that yes, the prices will go up further. This is an indication. The chances are that the prices will go up further. In the same way, if the gap in case of a downtrend or a bearish candle or a bearish chart, if the difference between opening and closing is greater, then it shows that the downtrend will be continue for some more time. So let us take an example of both the bullish and the you can say bearish scenario. Let us see a prominent candle. Eicher Motors. Let us take this chart of Eicher Motors itself here. Let us see some other chart. Here, on this day, 3rd of September 2021, Eicher Motors. Now, the market, the prices of Eicher Motors opens at 2742 and it reaches a high during the day at 2854, then come down 2854 to 2713, and then again closes at about 2802. So the market opens, when the market opens at 9:15, the Eicher Motors stock on a particular day, the day is given below 9/3/9/2021 in the bold. The opening prices, the given in your right hand side in black, that is 2737. So market at 9:15 of Eicher Motors on 3rd of September was 2737, but it closes at about 2799. So 2737 minus 2799, it have about 60 points gain during a particular day, 60 rupees. So the shares of Eicher Motors on 3rd of September increases by about 60 points, increases at about 60 rupees. So it is clearly indicate a bullish trend that the prices will continue for a long further time. If the gap between the closing and the opening is more, 60 rupees gap can be considered as a substantial gap. So it indicates a bullish trend. So on this basis, the technical analysts actually take decision. As we see that yes, the prices have increased further. Now, see a red candle or a bearish candle. See the market. Here it will be. Let us see some other candle. See the market opens at 2617. The market opens on 12th of August 2021 at 2619, at about 9:15 p.m. 9:15 a.m. In the afternoon at 3:30, it closes at 2729, open at 2619 and closes at 2731. So more than 100 rupees downfall in a single day. So this can be considered as a substantial trend, a substantial bearish trend. So the technical analyst, on the basis of this particular Japanese candlestick chart on a particular day, that is of 12th of August, can make a decision that yes, the market is in a downtrend, it is better to sell the shares of a particular stock. So this way the decisions are generally taken by the technical analyst. So gap between these two opening and closing are substantial, about 100 rupees on this particular day, that is 12th of August 2021. And we see that after that the prices have declined further during the subsequent days. So this way, on the basis of opening and closing, the decisions are taken by the technical analyst. Fine. Now, moving average I will take later because I will take practical questions on this. Let us take the evaluation of the technical analysis. If you have any question, please ask. Otherwise, I will move forward. What are the arguments in favor of the technical analysis? That is, why the technical analysts use these charts, graphs, bars while trading? Because the first point is that the crowd psychology works and trends generally continue for some time to come. We have seen that how human behavior, human psychology, crowd behavior, crowd psychology plays a big part in technical analysis because, and this is also you can say the theory propounded by DOW also. DOW also propounded that yes, when the market is showing a particular trend increasing, and this trend is generally initiated by the knowledgeable investors. When the retail investors see that yes, the trend is visible, it is in the uptrend, they start to purchase more. So there is an uptrend or a bullish scenario for some time to come. So this is what the first argument in favor of technical analysis, that is the human behavior, crowd psychology works. If some people are doing something, the other people will also join this. Second point in technical analysis is that it helps in detecting the shift in demand rather early and provides clues to future price movements. As we have seen, one of the most important principles of technical analysis that the market discounts everything, means the market or the price trends or the charts can also show whatever is likely to happen in the future. It also considers the future event also. It also reflects the future events. As I have given an example in case of the budget of 2022, budget of 2020. In the budget of 2020, which was declared on 3rd of February, generally the market came down. The NSE, the market came down because the budget was not good according to some of the people, because they were expecting tax exemption and they didn't get it. But actually the price decline shows 10 days earlier from 1st of January itself. Why? Because some insiders knew that the budget will not be that good. So they start selling from 10-12 days earlier. Hence, the technical analysis helps to detect the future events also. The prices reflect the future events also. Another point which the technical analysts generally give in their favor is that the fundamental information about a company is observed and assimilated by the market over a period of time. So it's said that generally the technical analysts believe that the fundamental analysis is not required. Whatever the fundamental analysis is in regard to economy, industry or company is reflected in the chart itself. So according to the technical analyst, the fundamental analysis is not required because such informations are already considered by the prices. There are certain arguments against the technical analysis, and these arguments are, first argument which is given against the technical analysis is the random walk theory. So random walk theory, as we have seen, that they generally raise doubt over the technical analysis. They believe that there is no guarantee that the previous trend will be repeated in the future also, because these are basically statistical expressions. I have seen discuss this with the help of example also, because it reacts to different news differently. Because first day the fire broke out, the news of fire broke out came, prices declined by 10%. Another day the news came that the entire products, entire garments have been damaged by the fire. Second day prices came down by 10%. On the third day the prices increased by 8% because the insurance, the news broke out that the insurance company you can say has agreed to you can say ensure the company will be able to recover almost the entire amount or most of the amount from the insurance company. So investors were convinced, market goes up by 5%. So the market reacts to different news differently, and it is no guarantee that the whatever happened now will happen in the future also. This is the belief of the random walk theorist. So this is what about the evaluation of this technical analysis portion. I will take some time to explain this efficient market hypothesis also. What is efficient market hypothesis? Efficient market hypothesis means at any given time, all available price sensitive information is fully reflected in the securities price. What it means? It means that no investor can outperform the market or control the market, because every information is available in the market, or the prices reflect all the information. This is efficient market hypothesis. There are three forms of efficient market hypothesis: weak form of efficiency, semi-strong form of efficiency, and the strong form of efficiency. Now let us take this one by one, these three forms of market efficiency. Weak form, semi-strong, and strong. Weak form of efficient market hypothesis means the market considers market prices reflect the past data. Means whatever has been happened in the past has already been reflected in the data, already been reflected in the market prices. It means that this will not be repeated in the future. So weak form of efficient market hypothesis is similar to random walk theory. It is similar to random walk theory. That is, the past prices have already been considered by the current market prices. It will not be repeated in the future. So market cannot be predicted. If the market is predicted, then the market is inefficient. If market is predicted, then market will be considered as inefficient. So efficient market hypothesis says the market cannot be predicted because all information is available. Semi-strong means past information, past data, as well as the all publicly available information. All publicly available information is reflected in the market price. I will take a small example to first of all let you understand this weak form of efficient market hypothesis. Let us say in the case of a particular company, say Hindustan Unilever Limited. You observe that for the past few weeks, the share prices of Hindustan Unilever Limited declines on Monday. I am taking a hypothetical situation, declines on Monday and then increases on Friday. And this is continuing for the past few weeks. On that information, as a technical analyst, you purchase the stock. But to your surprise, on this, the prices have declined on Monday, but didn't go up on Friday. In fact, it declined on Friday itself. So you can say the market is inefficient because it did not consider this. The past trend cannot be repeated in future. For the past few weeks, the trend is repeating. It does not mean that every week it will be repeated. Again, this is the example of Hindustan Unilever Limited. A practical example, hypothetical example. Let us take another company. Let us take another example, a weak form of hypothesis, so that you can understand it fully. An investor observes that for the last 5 years, the third quarter of Larsen and Toubro or L&T is very good. So what happens this year? He purchases the shares even before declaration of the quarterly results. But after the declaration of the results were not according to the expectation. It actually declined. The third quarter results of Larsen & Toubro showed losses. So the share prices come down. So again, this is an example of weak form of market hypothesis, that past trends which have been happened, there is no guarantee that it will continue in the future also. Okay. So I hope this is weak form hypothesis is understandable to you. Now let us consider this a semi-strong form of market hypothesis. Let us take an example so that you can understand that how the market price reflect both the past data as well as publicly available information. What are the publicly available information? The publicly available information may be if the company has publicly declared that it has such and such amount of dividend or bonus shares or any merger or an acquisition proposal or any change in the government rules and regulations. Let us take a hypothetical example. In case of a big retail company is actually planning to acquire another retail company which is big enough and which is very popular in the retail space. And it has given a public declaration also. Mr. A, an investor, actually invested in the shares of such company. After the declaration that such company, the big retail company, is able to increase its operations by acquiring another company, it reflected on the share market price, and the market prices increases by about 25%. It hikes about 25%. But Mr. A continues to hold shares in that company. After some time, the correction took place and the market went back to where it was. So he purchases the stock at rupees 100. Mr. A has purchases the stock at rupees 100. After the merger declaration, merger announcement, the share price increases by 25%, that is rupees 125. But after that, it declined. And came back to the previous level. So, what does it show? It shows that the present information, the market had already considered this information, this publicly available information. It will not go on increasing. So once it has considered this information, that is there. So the correction later take place and the market price is back to the previous level of rupees 100. So this is a classic example of semi-strong form of efficient market hypothesis, that the market absorbs not only the past information but also the publicly available information. Now come to the strong form of capital market hypothesis. Strong form of capital market hypothesis means it not only considers the past information but also the present, but also the publicly available information, as also the private information, past data, public information and private information. So what are this private information? This private information is actually the insider information. The insiders which in the company CFO, CEO, CEO. Let us take a practical example to understand that strong form of capital market hypothesis. For example, A is a chief technology officer of a particular company, or you can say XYZ. And this XYZ Limited is coming out with a new technology. To increase its production. New technology to increase production by using, you can say, artificial intelligence. But this information is private. No public declaration regarding this information is made by the XYZ to the investors. But A, being a chief technology officer, is aware of this development. So he purchases the shares. So he buys the shares, purchases the shares. After some time, the public announcement is made that the company is coming out with a new technology so that it can increase its production using artificial intelligence. So the share prices goes up. The share prices goes up by say 5%. But A is expecting a hike of at least 20 to 25%. He didn't get that increase. What is the reason? The reason was that this insider information is already considered by the market. Like A, there are other insiders also. There is the company's chief executive officer, company's chief financial officer, company's chief operating officer, chief compliance officer. So these people must have been knowing this private information, this insider information, that the company is coming out with a new technology to boost its production. So they must have purchased the shares, or they may have circulated the information to other investors also who may have purchased the shares. And that must have been reflected in the charts also. Charts will not lie. It may have shown a particular trend. Also. Here. So the prices may already have started increasing. After the declaration, that is announcement here, the price may have increases, but not increased that much after the correction took place, because this inside information have already been observed by the market. Since they have started purchasing it, it has been reflected in the charts. So charts have already shown an increasing trend. So as per the strong form of market hypothesis, the market observes or reflect the future information, the private information also, the insider information also. So you can say, as per the strong market hypothesis, the market cannot be predicted fully. So actually, practically, the strong form of hypothesis hold goods, because on the basis of trends, decision regarding buy and sell can be taken, but market cannot be fully 100% predicted. So this is what efficient market hypothesis is, and my presentation for this today. Let's see if anything comes, then I will share it. There are certain challenges to the efficient market theory. I will take these challenges tomorrow. I will revise the entire thing, and I will take these challenges to efficient market theory day after tomorrow. The next class will be on Wednesday. So after that, I will be taking some practical problems in technical analysis. I will give you an assignment, share an assignment with you, in which I will be taking practical problems in simple moving average, exponential moving average, and some other practical problems in this technical analysis, the run test also. Okay. So I will urge you to revise this portion. Whatever queries you have, you can ask in my next session, which will be on Wednesday, that is 10th of November. So thank you so much, and over to you, Ashish sir.
Am I audible?
Yes, sir, you are audible.
Okay, thanks for your very nice presentation. Initial, you have quoted very good example that if we go for any outing, then we go for a lunch. We have to how we locate a good restaurant. But here I will make some more addition, as you are using the word insider information. Because when we used to go on audit, even our students may be going on the audit. So it is a common practice whenever we go on audit. What we do, we ask the office staff which hotel is better here, and straightway we go there. So you can say it is a one kind of an example of insider information. But student, please note, as Vivek sir has in this session, when he is explaining the efficient market hypothesis. Now please note, insider information cannot be used so much vaguely, because now SEBI is very strict about the same. every day you can read in the newspaper that I think in a 1 or 2 day back, 2 or 3 days back, some news has come that SEBI may be banning the MF mutual fund scheme staff from trading in the mutual fund of the same scheme. So students, please note that use of insider information is not that easy. There is always a whistle on you. You are trading, and of course you can be in a problem. And in this connection, I will like to you can refer a case study that is of the Rajat Gupta of Morgan Stanley. I think that is a very prime case study where the insider information has been utilized, and a federal authority of America has taken a very strict action against this guy Rajat Gupta. So students, please be careful. Don't go by any tip, etc. And as we told in the very beginning that these classes are meant for only for your academic purpose. Next thing, one student has asked about the cryptocurrency. Student, my view here is that cryptocurrency is not like a security. Okay, because if you buy and sell any security basically is like you can say it is a part of a company which is working, who has some asset, who has some working. But cryptocurrency is not that kind of a thing. Cryptocurrency is a only medium of exchange. However, their price has been recently it has been inflated that much. It is not actually having their intrinsic value. Please remember, cryptocurrency does not have any intrinsic value. So if you are analyzing the cryptocurrency with like a market, I think there may be some different. And on the platform of the Institute of Chartered of India, normally we never discuss any about the cryptocurrency. Although a concept has been coming out, the RBI has come out with a concept paper of central bank digital currency, CBDC. So CBDC is nothing but it is a replacement of the rupee, paper rupee. So there are differences between cryptocurrency and CBDC. Basically, in a CBDC is nothing. It is a replacement of a rupee or an currency, and it is backed by the central bank of that country. These have a legal framework, and more important, in a cryptocurrency, normally it is driven by some community, but it is not driven by the community. CBDC is not driven by the community. It is regulated by the central bank. Okay, so there cannot be problem. But cryptocurrency, no one can be held responsible. And another important aspect is that digital currency is centralized, whereas cryptocurrency is decentralized. So my request to you students, please don't go by the lucrative return on the cryptocurrency, because normally every day in a newspaper they are coming like news like that this much of increase is going to be there. So please stay away from all these practices. Just concentrate on your academic study. Vivek shall continue technical analysis in the next class, that is day after tomorrow. Till then, whatever you have studied, please revise it. And normally from this chapter, theoretical as well as numerical questions both are asked. So you should be thorough with it. But however, please remember, technical analysis is a very vast topic. We have kept here very limited coverage because there is no end to the technical analysis. There are many theories. Every technical analysis their own theory. So please be limited to the syllabus. And because that much topic may not carry that much weightage in your examination, so keeping it that view, just keep yourself limited to the study material and the syllabus. Okay, thanks a lot, Vivek, for sharing your views and your efforts that you have put in there, making this class very successful. So students, see you day after tomorrow. Till then, please revise the same. Okay, Vivek, thanks a lot.
Thank you, sir. Thank you, students.